Welcome everyone to a new episode of Why Not Mint Money, your go-to podcast for everything personal finance and investments. So today we have Nikhil with us, who is the CEO of Grip and a founder and CEO of GripInvest, an alternative investments platform that deals with invoice discounting, asset leasing, bonds, and a lot of other things that you'll know from him right now. So today we are going to discuss a new and exciting asset class for the retail investors, that is invoice discounting. So Nikhil, how's Delhi's humidity?
I think it's been a better summer plus monsoon than we can complain about, and definitely better weather than most countries in the world are today dealing with. So I don't think we have the ability to complain about weather in Delhi.
So let's talk about asset lease. Let's talk about invoice discounting. So retail investors can now fund MSMEs, which are the backbone of Indian economy, through these retail invoice discounting platforms. So could you take us through the journey of how this works, the invoice discounting thing works?
I'll absolutely do that, and thank you for having me on the podcast. Just before we start, I think it's fascinating, and we are constantly on this learning journey. As people in school, even as in our families, we never talked about fixed income as a way of generating money, as a way of generating returns. It was always told to us that it needs to be put in fixed deposits as a rainy day fund, as a safe fund. I think at Grip and through Grip, we've been able to discover that there are many such avenues where fixed income can generate very attractive returns, and invoice discounting, or what on Grip's platform is called Invoice X, is one of those products. To answer your question, MSMEs provide services, right? One of the biggest challenge for them is that they do not receive money at the time of provision of goods or services. They're typically dealing with larger companies who say, hey, I need 90 days to make payment, right? And the MSME needs money today. What he commonly does is to go to a bank or to an NBFC or any form of money lender and asks for a loan to discount his invoice, all right? And he says, company X is going to be paying me 90 days later. You can take it, but give me the money today. The money lender makes money. The bank, NBFC, all of these guys make money. But this construct was not available for an individual investor to participate from. What we have done with Invoice X and many other platforms with invoice discounting is create this into a retail investment product. I think we have approached some things differently, though the flow of the money is the same. One of the key differences, and we were very focused on solving this at Grip, is that a single invoice can be an incredibly risky investment to make, right? You have complete concentration of risk. In Invoice X, we've actually created a very large pool of invoices, actually 200 invoices, against 20 different companies, and hence reduce the risk that the investor has. There are many other features, but effectively, to answer your question, this is the flow that happens for an investor.
Okay. So what kind of returns could individual investors expect in this product? And a question related to that is that a lot of these platforms use IRR as a metric, and a retail investor, a retail guy like me, or a lot of people like us don't understand that metric as such. So could you guide us through that?
Sure. Returns, in our view, should always be looked in comparison to risk, right? There's no way to just talk about returns. So let me take a minute on the risk of Invoice X and come to return and IRR. With Invoice X, and I'm talking about this product and not invoice discounting in total, risk should be looked at first, that it's a diversified pool of 200 invoices. Number two, the companies who have to pay against these invoices, majority of them are investment grade. For example, in our first transaction, you would have companies like TCS, Wipro, L&T, as companies who have to pay against the invoices, and hence that reduces the risk. Third is the NBFC partner that we work with, a company called Credible, which is one of the leaders in the space, has also taken skin in the game, and up to 20% of the first loss is borne by the NBFC. So the investor up to 20% is protected by the NBFC. This is obviously a short-term instrument, and hence from a rating perspective, it is rated as A1+ or the highest short-term rating. Against this, an investor is today getting 11.25% as an IRR. One other way to look at it is what is the returns on a similar instrument, similar rated instrument, and we're seeing almost 300 basis points delta to that of another instrument, making this a very attractive product. On your question on IRR, I think this is a hotly debated topic, something that Grip has had, we've dealt from day one. There are pros and cons of the IRR. The IRR is a representative instrument, especially when returns come frequently. Yield is a great instrument to measure when it comes at the end. Majority of Grip's products or majority of products on Grip have a monthly payment phenomena, and hence we use IRR to measure it. The downside of IRR is that it assumes that money is reinvested the same rate for you to be able to earn the return, right? So I think IRR is good for comparison to another instrument on an IRR basis. But in absolute terms, it can give a misleading information to think about absolute returns. On our platform, hence, we are giving both information. We give the IRR, but we also talk about absolute returns. I think the last thing we do is to try to explain to our users the power of reinvestment, right? Money can only be made or is best made on more money. And hence the monthly returns they get should be reinvested to really give you that impact of the IRR.
So counter question on this, most invoice discounting deals involve in an investment and an outflow at the end. So in InvoiceX, are there monthly payments or is the same thing is happening that you invest and after 9 months you get the matured amount?
In InvoiceX, again, this is a special feature. You actually get monthly payments. Because they are structured as a pool, so there are constant payouts that happen, and hence you actually get money on a monthly basis. This reduces capital and obviously increases the IRR. No other invoice discounting product has this feature.
So that means IRR is definitely a representative metric for you guys, but not for the industry, because so that's a thing that I wanted to kind of get to the audience.
And we have, for example, we offer corporate bonds, which we communicate on a YTM basis or yield to maturity basis, because they pay out at the end of the tenure. So because instruments are different, we have to use different measures which truly represent the cash flows, the pattern of cash flows.
So InvoiceX is inherently structured as a PTC. It's passed through certificate. So let's spend some time of understanding what are PTCs, who could create a PTC, and how your transaction as a PTC and an SPV works. So could you explain to the audience about that?
It's very fascinating. Most financial products are 3-letter acronyms, right? It's really NCD, IPO, PTC. And they all sound complicated, but let's try to simplify it. PTC stands for pass-through certificate. The simple concept is that there is no tax or loss to the investor, ultimate investor, by holding this instrument, because it is passed through for any intermediate entity. That's why it's called pass-through certificate, right? A pass-through certificate is very good to be able to convert a large opportunity into a smaller size opportunity. The InvoiceX, if I take an example, is actually an 11 crore opportunity on our platform, but it is available for investors currently at 10 lakhs and in the future at 1 lakh rupee. Fractionalizing this is really what a PTC is able to solve. Very simple, in very simple structure. One of the most exciting aspects in our history at Grip was that we were the first company to ever list an alternative investment instrument on the stock exchange. This was in October 22, and the PTC was called an SDI, another 3-letter acronym. But this is a SEBI-regulated paper called SDI, and we were the first company to list it. This SDI allows that fractionalization to happen and for us to be able to offer it to retail investors on our platform. Whether it's InvoiceX or LoanX on our platform or LeaseX on our platform, all of them use the same structure, and all of it is obviously compliant under SEBI regulations.
Understood. So let's discuss some of the risks, inherent risks in these products. So you mentioned that InvoiceX is a diversified pool of invoices, 200 invoices. What we observed on platforms like Giraffe and Credix, a lot of these deals belong to I think 45-47% what research that we had done at Mint to a certain 3-4 companies and to a sector like manufacturing. So I went through your InvoiceX, the memo. So I think 64% of your InvoiceX invoices are still in manufacturing. So does sector concentration also kind of project as a risk to the investors, or it's the industry standard that manufacturing requires more invoices to be discounted?
I think manufacturing does tend to require more invoices, and the nature of the industry also, because there are raw materials that payment is required for, naturally require it. Let me not comment on other platforms, but I think the one is manufacturing as a sector will have a certain place to play. Within manufacturing, I think the question to ask is that a single invoice? Is it against a single company? I think in the InvoiceX product that Grip has, that manufacturing is itself against 12 or 15 companies, right? And hundreds of invoices. So that is the diversification that protects the risk for the investor, and obviously the quality of companies that are behind it.
Understood. So let's talk about the taxation bit of the product at InvoiceX and regular platforms, if you want to comment. So I talked to certain retail investors who are investing in these products. So the companies basically deduct the TDS, and they have to in the retail investors' income tax returns, it appears in the 26AS. But these companies are not filing these TDS with the MC on time. So does InvoiceX also have certain kind of, should I say, like risks related to this, or it's happening with invoice discounting platforms that do direct invoice discounting?
Sure. Again, let me keep it to this thing. I can understand the risk, and keeping that in mind, we have also tried to mitigate it. Under this PTC or SD I talked about, actually, we have not tried to mitigate it, SEBI has mitigated it. SEBI has said there must be an independent party who is responsible for deducting TDS and for filing all of these details for the customer's 26AS. This party is called a trustee. And SEBI has given a license to a select set of companies to act as trustees. These are no way related to Grip or related to the companies who take the invoices. And it is this trustee's responsibility to actually deduct TDS and to file the 26AS. It is actually, and hence, in that sense, investors on buying InvoiceX or through Grip can actually be rest assured that the TDS will be deducted correctly and filed correctly, because a SEBI registered entity, which has to then do reporting, is responsible for doing it. It is not something that we as a business have to do, and this creates a lot of comfort for investors.
Understood. So let's discuss the elephant in the room, if I would say, the default delay / liquidity risk that these products bring with them. So, and this also brings us to a debate of operational versus financial creditors that has been discussed a lot in the previous whenever these products are talked about. So obviously I wouldn't want you to comment on specific platforms, but platforms like CredX and Giraffe have faced a lot of delays and some defaults as well. Some invoice payments are pending on platforms like CredX for more than a year and a half. And so there have been court cases. So if I were to refer to a case, there was case Minions versus Startup Projects, which kind of made it clear that platforms like CredX have no recourse on the buyer of the goods. For example, in this case, Startup Projects, they have recourse on the vendor. So inherently, they have become an operational creditor. And but as we talked about, that your product kind of solves this, and the investors become a financial creditors through the PTC transaction. So could you shed more light on this and how to deal with that?
At a high level, I would say that investors must understand that there is a risk in all of these products. Whether it's on our platform or on other platforms, there is a reason that the returns are higher.
Right.
It is because inherently there is some risk. As they think about allocating capital, they must keep this in mind, right? I have always said that the instruments we create are not a replacement to fixed deposits.
Right.
please build a good fixed deposit nest for yourself. And when you're looking for diversification or you want to allocate a certain part of your portfolio for high returns, alternative investments is the right place to be. That's how global investment philosophy happens, right? With that overall construct, I think there are ways to mitigate risk in every instrument. Number one, in Invoice X, and again, all the products that we create, yes, there is a financial creditor that a lens gets applied. But I think more importantly, there is a security provided by the NBFC, the originating NBFC, which I mentioned is the form of cash over collateralization and can be up to 20% of the investment amount, right? You'll be, tell me which NBFC has a 20% NPA, right? Which PTC transactions, and PTC happens, $20 billion of PTC happen in the country. Where have we heard of a 20% NPA, right? So I think the level of security created in some of these transactions is very high, and hence there is a protection for the investor. The way the invoices are secured, some of them, I won't say all of them, some of them also have recourse to the buyer, okay? Including in the pool that we have created, there's a recourse to the buyer. It may not be in 100%, but the combination of that recourse, the security structure, the monthly repayments provides a great degree of comfort from an investor's point of view.
Understood. So let's talk about Treads as created by RBI. So Treads has been an interesting platform for invoice discounting for the corporates, and I think a couple of months back RBI allowed insurers to get on the platform and provide embedded credit insurance. So do you think letting retail on Treads and let them transact and get the benefit of those deals could open up this asset class into a bigger kind of phenomenon?
I have a view of the world which is to say that almost all services, forget financial aid, all services have led to larger and larger empowerment of the individual, right? And technology has been a huge enabler of that. The fact that you and I can today access the supercomputing power of ChatGPT for $20 is like the epitome of that empowerment, right? It is shocking that empowerment has not happened for investment products, okay? In the future, individuals like you and I will be able to make any type of investment sitting at home, empowered with information and access. That is our view of the world. In that scenario, it's important for all financial products and all financial platforms to ultimately get open to retail investors. There has to be certain safeguards. And I think one of the best things SEBI has done in the last 1 year is to come out with regulations like the OBPP framework, clearly putting safeguards in place. But I do think that we are headed in that direction over a period of time. Could be the Treads platform. I don't know what time frame, but I think those are great steps to happen. How do you communicate the risk? How do you create a pool? How do you tell a person that what is the rating of this product? How do you exit it? I think those are all questions. OBPP as a regulation solves most of them, and that is what the SDI product, Invoice X, Loan X are doing. But we are hopeful that in the future, more such platforms that the government has will open up, or regulatory bodies will open up to retail investors.
Understood. So Nikhil, thank you very much for coming on this podcast. So just parting thoughts. What would you like? Anything you would like to recommend to our listeners? Any books or any investment philosophies? Anything, whatever you want to give to our listeners.
Maybe not investment philosophies. I think that's each to his own. I think there are 2 books that I read recently, which I immediately as you ask the question, I think comes to mind. One is a book I read by, and it defines a lot of things what we do at Grip. So maybe that's why it came up to me. One is a book by Steve Schwarzman, who is the founder of Blackstone. I think the approach with which he built Blackstone into an institution in a very small period of time, and a premier financial institution across asset classes, I think is inspirational. I think the second book that I read recently is called Loonshots. So it's Moonshots with an L. And it talks about how companies need to not only innovate, but they need to build engines to innovate and operate like industrial complexes, machines at the same time. What we have seen often is companies either innovate or they either execute, but they sometimes struggle to do both. And I think the combination of the two is really when business or magic happens. So I think these are two, well, you asked this question, so these are the two books that came immediately to mind. None of them to do with investing, but more to do with business.
Right. So thank you, Nikhil, and thanks for everyone for tuning in, and we'll keep you posted for more podcasts like this. Thank you.
How can I achieve my targets? How can I target the remotest markets?
You only progress when you ask better questions. Mint. Think ahead, think growth.